Hi everyone, good morning. Welcome back to our marathon series. Hello everyone. Okay, welcome back to our marathon series wherein we are doing our corporate accounting and financial management marathon for our upcoming exams. Just for a brief introduction, I am Fatima Kagalwala and I have been teaching CA and FM and practical subjects for over 8 years now, and trust me, my journey for CS has been a fantastic one. I have kind of managed to get exemption, in fact, more than that in these type of papers, and I want all my students in to follow the same thing I am doing, and that can help them to get complete coverage of their syllabus and get good marks even if they are starting now. Okay, so just focus on what has to be done from the exam point of view. That is going to be my main important, my motive is to teach you all in the manner which is going to help you solve your question paper. Okay, so I am going to share my notes. My timetable was already shared, and today we are starting with the financial management marathon. I'm going to follow the same manner like how we did for corporate accounting. We are going to do the basic concepts, we will solve some questions, and then we will move to the past exam question. Okay, so your past exam questions are also as per what the institute is expecting you all to answer in that manner. Okay, and there is face-to-face sessions available. You all can drop into our Andheri West branch wherein here, and we can stay connected even online, and we can stay connected personally where I'll be able to solve your doubts, help you all face to face, and we can interact together. So keep all your distractions aside, just keep a pen paper and keep your calces with you. Okay, rest everything I have given it to you all. There are notes, question notes, there are solution notes also, so you really don't have to sit and copy. Okay, you can just refer to the solutions, understand what I am teaching, and then later on you all can solve it as a practice questions in your own books. Okay, so this is the time we build ourselves, towards our goal of becoming a company secretary. And I want you all to ace these exams, get good marks. It is a very interesting paper, and actually it is simple. Okay, to begin with, it is actually very easy. It's just if you all have understood the concepts, everything is going to fall in place. All right, so let us begin. Just put a thumbs up if you all are with me. You all can see my screen, and you all can also, am I audible enough, clear? I just want you all to put a thumbs up so that I can begin with the class. Okay, All right. So hello everyone, once again welcome back to our financial management marathon. Today is our first marathon wherein we are going to start with our basic chapter, which is leverages. Okay, now if you all go ahead and you all see this chapter in the module, it is the part of your capital structure chapter. Okay, it is one of the most important part of that chapter, capital structure. Okay, now what do we understand by leverages? If we understand the meaning, no, everything is very simple. Okay, then there are these financial terms which will follow, but what do we mean by a leverage? Leverage in general term it is basically a kind of a benefit. Okay, it is a kind of a relationship, right? Leverage is a relationship. If you see here, it is a relationship, but relationship between two factors, from which one can be a dependent factor and one can be an independent factor. Okay, just take for an example that today we are seeing our financials and we say that the sales have increased by 10% as compared to the last quarter. This quarter the sales have increased by 10%. So does that necessarily mean that profit has also increased by 10%? Obviously, sales has increased, the profit will also increase. But that does not necessarily mean that they increase in the same ratio. Profit is a dependent factor. Dependent on what? Sales. If sales will increase, profit will obviously increase. But if the sales will decrease, the profit will also decrease. But that's not necessary. The proportion of that increase is the same. The rate of that increase is same. Why? Because there is some type of a cost which is involved. Sales has direct relationship with the variable cost also. Whatever number of units you are going to sell, that much amount of variable cost, because they are directly related to each other. Okay, so sales and variable cost again directly related to each other. If the sales will change, the variable cost will vary accordingly. Okay, it can be calculated as a fixed percentage of sales. That sales is 100, variable cost is 40% of that sales always. So variable cost is not a problem. What happens is there is a fixed cost involved. Whether you are going to sell 1 unit or whether you are going to sell 100 units, this fixed cost you have to pay. For example, this class. Okay, if I am having 1 student, I am going to pay the rent for this class, I am going to pay the electricity for this class. Even if I am going to have 20 students, I am going to pay the same rent and I am going to pay the same electricity. Okay, so because there is a fixed cost which is involved, in order to arrive to the profit, the change in the ratio is different. So sales will increase by 10%, but not necessarily that profit will also increase by 10%. Okay. Now before I take you all to the leverages, I want to take you all to the income statement. Okay. This is the general basic income statement which we make, right? This is how we have been doing even in our corporate accounting class also, right? So we are doing this already. So income statement, simple income statement wherein we say whatever is the sales amount. From that we remove the variable expenses. That gives us contribution. So this is a contribution. Okay, from which we will remove our fixed expenses, and that will give us the NPBIT, net profit before interest and tax, earnings before interest and tax. From there then I remove my interest, I get my net profit before tax. From there I will remove my tax, I'll get net profit after tax, that is the profit available for the equity shareholders. So number of shares, I will get my earning per share. This is basically the income statement, the basic income statement which we are going to use in the leverage. Okay. So now, say suppose, for example, My sales is 100 rupees. Okay, and my variable cost say is 40%. Okay, so it is 40 rupees variable expenses at the rate of 40% of sales. So now I am going to have a contribution of 60. Fixed expenses is fixed in nature, 10. So say now my NPBIT is going to be rupees 50. There is an interest expenses of 10 rupees again. So now my NPBT is going to be 40. Say tax rate is at the rate of 20%. Okay, tax rate is going to be 20%. I'm just giving you all one example to show you all that the sales, if the sales will increase, how much will the profit increase? Okay, let us understand this. So say on 40 rupees, I have 20% of my tax. Okay, so 8 rupees is the tax. Correct? So 32 rupees is the net profit after tax. Okay, until here only I am doing right now. So basically I have arrived to the profit after tax now. Say suppose there is an increase in my sales by 10%. My sales have now increased by 10%. So 100 plus 10% is going to be 110 now. Right? 110 into 40% is going to be 44. So now I am going to get 66 over here. Fixed expenses is going to remain the same. There is no change in the fixed expense. Right, so I am going to get 56 as my net profit before interest and tax. Again, interest is same. So I am going to get my net profit before tax. Now tax rate is 20%. Now 20% of 46 is 9.2. Okay. So my profit after tax is coming as 36.8. Okay, now let us see how much has the change in the profit taken place. From 32, my profit has now become 36.8. That means how much increase has happened? From 32, it has become 36.8. So the increase is only of 4.8 rupees. What is the base? 32. Always whenever I find the increase, okay, in a level of this profit, so I will take the difference upon the base amount. So the difference is 4.8. 4.8 divided by 32%. See, 15% is the increase in profit. So though the sales have increased by 10%, my change or increase in the profit is not necessarily 10%. It is 15%. So tomorrow if my sales will decline by 10%, my profit will also decline by 15% and not 10%. Okay. So leverages are basically to find out how much of operating or financial leverage do you have. That means how much, if the sales is changing by 1, how much is your profit changing? How much is your NPBIT changing, or how much is your NPBT changing due to the change in sales? If sales is changing and independent variable is changing, then how much does your NPBIT or NPBT change? That is what is known as leverages, to find the amount of change in the variable depending upon one independent variable. Okay, so in leverages we have 3 types. Okay, one is your operating leverage, one is your financial leverage. So you have a degree of operating leverage, then you have a degree of financial leverage, and when you combine both, you multiply both, you get degree of the combined leverage. Okay, so now what is operating leverage? Operating leverage takes into account the operating expenses in order to find the change from sales, because of the sales, to find the change in the profit. And financial leverage takes into account the interest factor, because interest is related to finance. So it takes into account the interest expenses to find the change between the variables. So basically, operating leverage is nothing but an ability of the company to kind of absorb its fixed operating cost. How much it can absorb its fixed operating cost before arriving at NPBIT. Okay, and the basic simple formula for this degree of operating leverage is nothing but contribution upon NPBIT. For now, just keep the formula in mind. Okay, generally the formula would be how much percentage of change has come in NPBIT upon percentage change in sales. Sales is an independent variable. We are finding that if the sales is changing, how much is the profit getting affected, right? So here I am taking an NPBIT profit. But in short form, it is contribution upon NPBIT. Now how? Again going back to the income statement. Here, I told you it is the ability of the company, of the firm's ability to absorb its fixed operating expenses in order to arrive at NPBIT. So what are the fixed expenses? Where is the fixed expenses? It is here, right? It is over here. So it is between contribution and NPBIT. So my formula also for degree of operating leverage is nothing but contribution upon NPBIT. Right? Same thing for financial leverage. The firm's ability to absorb the financial related expenses like interest. Where is interest? It is here. Okay. So interest is falling between what? NPBIT and NPBT. So my degree of financial leverage is nothing but NPBIT upon NP. Right, this is the short form. Okay, so degree of operating leverage, degree of financial leverage, and degree of combined leverage is nothing but degree of operating into degree of financial leverage. So when you will multiply them, your contribution upon NPBIT into NPBIT upon NPBT. NPBIT cut, contribution upon NPBT. Yes, it has to be. Why? Because you see this interest is also getting absorbed, fixed expenses is also getting absorbed. So it is between contribution and NPBT, right? Contribution and NPBT. So this will be a degree of combined leverage. Okay, so for us, formulas are very important for all these three leverages. Okay. So now just see this one simple example and interpretation. For example, I am saying that my company's degree of operating leverage is 1.33 times. It indicates that the NPBIT is more sensitive with respect to the sales. So say suppose if your sales will change by 10%, how much is going to this NPBIT change? Obviously by 13.3%, because your leverage is 1. If your sales is changing by 1, your NPBIT is changing by 1.33. So if your sales is changing by 10, by how much is your NPBIT going to change? Simple, multiply. We generally do cross multiply. 10 into 1. My NPBIT will increase by 13.3%. Right? If sales will increase by 10%, NPBIT will increase by 13.3%. Same like our example. Okay, and if it decreases by 10%, the NPBIT will decrease by 13.3%. Okay. Now, change in the operating income and change in the sales. That was all about degree of operating leverage. Coming to the degree of financial leverage, I just told you that how much is the firm's ability to pay the interest expenses and arrive at the net profit before tax. Okay. So, percentage change in earnings before tax, divide that by percentage change in EBIT. But the formula will be NPBIT upon NPBT, degree of financial leverage. Some companies might also not have financial leverage. They have not taken any loan. They don't have any kind of a borrowed finance. So So they will not have any interest payment also. Okay, for example, we have Just Dial, Oracle, all those type of some companies who do not have any kind of a financial leverage. Now, last one is your degree of combined leverage, which I explained it to you all. It is a multiplication of operating and financial leverage, and therefore the answer is going to come as contribution upon NPBT. It is the last one, percentage change in the earning per share upon percentage change in the sales, the direct relationship. Okay, that is your combined leverage. I hope until now it is all clear. Okay, now for that, let us solve one question. Okay, when we'll solve a question, we will solve the income statement. We'll be able to answer the question and able to understand the concept in a better way. Correct? So far clear everyone up till now? So just put a thumbs up, or you can just hit the like button so that I know you all are with me, you all can hear, you all can see. I just want to be sure that you all are with me. Okay, come on. Now starting with the question, I'll just read the question. A simplified income statement of Zenith Limited is given. Okay, they are saying sales of 31st March 98. Sales is 10,50,000. They have a variable cost of 7,67,000, fixed cost 75. NPBIT is 2,08,000. Interest amount is 1,10,000. Tax at the rate of 30% and net income. They are telling us find the degree of operating leverage, financial leverage and combined leverage. This will be the type of questions even in your exam. Though it will be a part of some question, but they will ask you this for 5 marks and it is very, very easy. Okay, nothing you all have to do in this type of sums. So, let us solve the sum. I am going to make the income statement. Though everything is given, but I will make my income statement. Sales is given to me. Okay, so for sales, given 10,50,000. Variable cost, I am going to subtract it 7,67,000. My contribution is 2,80,000. Okay, so for my operating leverage, I need contribution, right? Fixed expenses, it is given. Yes, it is given. Fixed expenses 75. NPBIT 2,08,000. Interest given. Yes, it is given 1,10,000. NPBT 98,000. I have just made the income statement only till here. Why? Because all my formulas which I have to solve, I have to take the figures only from this until this, only this income statement is needed. Rest nothing I need. So degree of my operating leverage. Operating leverage means I am talking about my this expense. Ability to absorb my fixed operating expense. It is between contribution and NPBIT. So C upon NPBIT, contribution upon NPBIT, 2,83,000 upon 2,08,000. 1.36 times. It will always be in times, right? So it was contribution and NPBI. Now the next one is degree of financial leverage. The company's ability to absorb the interest expenses. So it is between NPBIT and NPBT. So degree of financial leverage, NPBIT upon NPBT. We have already solved everything. So 2,08,000 upon 98,000, 2.12 times. And degree of combined leverage is just a multiplication of both operating and financial. So 2.88 times. Okay. So one basic question we have solved. Okay. So this can also be asked in the exams. But more likely that they will ask you these questions and then they will add on certain relationship establishment. They will tell you, okay, now if the sales is going to increase by 10%, how much is NPBIT going to increase? Or how much is NPBT going to increase? Okay, so they are going to give you some kind of a establishment of relationship and finding the amount of increase in that particular dependent variable. Now see, you are required to prepare the income statement from the following information. It is related to Sunrise Limited. They have given me sales, they have given me variable expenses 35%, 1,40,000. They are giving me contribution, they have given me fixed expense, NPBIT, less interest and taxable income. That is NPBT. Okay, so they have made the income statement. You are required to submit the following management to the management of the company. They are saying what percentage will the taxable income NPBT increase if the sales is increasing by 6%. So they are asking me relationship between sales and taxable income. Both the expenses are coming, operating and finance. That means they are asking me degree of combined leverage related. Only combined leverage will help me to understand the relationship between the taxable income and sales. See, they have written also use combined leverage. What percentage will NPBIT increase if there is a 10% increase in sales? They are asking how much NPBIT will increase if there is a 10% increase in sales. So, relationship between sales and NPBIT, only one expense is getting absorbed, operating. So, I will use my degree of operating leverage. What percentage will taxable income increase if NPBIT increases by 6%? So, if NPBIT here is increasing by 6%, how much taxable income will increase, they are asking. So, only one expense is getting absorbed over your financial, right, between both of them. So, obviously they are asking me relating to the financial. I will use the degree of financial leverage to find the answers for this question. Okay. So, now let us solve it using the leverage to calculate the increase and decrease. First, find the degree of combined leverage because the first question is based on that. So, combined leverage is how, what is the formula for the combined leverage? It is contribution upon NPBT. NPBT also we have contribution also with us. So, contribution upon NPBT, 3.714 times you are going to get something like this. Okay, now I have made the working note. They are saying that find the increase in NPBIT if the sales increases by 6%. Okay, understand. The degree of operating leverage is 3.714 times. Means what? That if my sales is increasing by 1, my NPBIT is increasing by 3.714. Now, if the sales is increasing by 6, how much will NPBIT increase by, NPBT, net profit before tax. How much will NPBT increase by? Simple, I'll have to multiply that with the degree of my combined leverage. 6 into 3.714, 22.284. So, can you see how much of difference is there? That if your sales will increase only by 6%, change in your profit before tax is going to be by 22.284%. Okay. Next question they are asking me, what percentage will NPBIT increase if there is a 10% increase in sales? So they are asking me relationship between NPBIT and sales. So I am going to use degree of operating leverage. So find the degree of operating leverage first. Contribution upon NPBIT. Contribution upon NPBIT. All this is given. So it is coming to 3.25 times. So that means if sales is increasing by 1%, NPBIT is going to increase by 3.25. They have told me sales has increased by 10%. So by how much percentage will my NPBIT increase by? Simple, multiply. You can even do cross multiplication, the same thing. No, you will do 10 into 3.5 divided by 1. Right? So if your sales will increase by 10%, my NPBIT will increase by 32.5%. Last, they are telling me what percentage will my taxable income increase if NPBIT increases by 6%. So NPBIT and NPBT. So there is a relationship here. Okay, which one? Financial leverage. Why? Because only interest expense is there in between. Correct? So I am going to use my financial leverage. What is the degree of financial leverage formula? NPBIT upon NPBT. NPBIT upon NPBT. With the help of the income statement, formulas become very simple. 80,000 upon 70,000. 1.14 times. So if your NPBIT increases by 1%, okay, your NPBT is going to increase by how much? 1.14 times. So now they are saying NPBIT is increasing by 6%. So by how much will my NPBT increase? 6.84. Cross multiply or just multiply 1.14 into 6, you are going to get 6.84 percentage. Okay. So this is important with the help of the leverages. Finding out the change in the dependent variable based on the change given about a independent variable. We are supposed to use the leverages for the purpose of finding out this particular answers. Okay. So in case of leverages, we are supposed to know this three important thing: operating, financial and combined, and this type of sums. There is a past exam question of leverages also which we are going to solve. But first we are going to do cost of capital. With the help of the cost of capital, there is one sum in which we are supposed to find the leverages as well. Okay. So now let us begin with our cost of capital. Again, very easy. These two chapters are very simple, and that is how I take my marathon of these two chapters always together almost. And my past exam questions are also combined because they have asked a combined question. Okay. Now, cost of capital. Okay. Now for cost of capital, always think from the company point of view. Even in case of financial management or corporate accounts, I always keep telling you all this thing, that please kindly think from the company point of view. Then you will not go wrong, even in your journal entries, and even at the time of when you are analyzing or interpreting anything in case of financial management or solving any formulas, questions, etc. Okay. So for cost of capital also, I will think from the company point of view. See, what is basically, it is capital means what? You need money, right? Company is needing money to run the business. Okay, so capital of the business is just used for the purpose of running the business. Now there are sources of capital, basic two sources of capital. One is your own funds, okay, where shareholders are involved. Okay, and one is the borrowed funds where the creditors are involved. Right? In borrowed funds, there are basically only two types: debentures, or you take a bank loan and then you pay them the interest. Okay, on debentures you pay them the interest, and in case of loan we have that EMI factor wherein we have an interest payment also in that, right? So this is one, borrowed funds, and in case of own funds we have your equity share capital and we have preference share capital. Okay, in both the cases we pay dividend. Preference dividend we pay irrespective whether there is profit or whether there is no profit, and equity dividend depends upon how much profit is made, how much they want to retain in the business, and how much dividend they want to declare out of the remaining amount. Okay, so preference dividend is also fixed cost. Interest interest on debentures and loan, again a fixed cost. Equity dividend, everything, it comes with a cost. Okay, it's not for free, right? Any capital which the company has taken is not for free. So say if now whenever a company is acquiring capital in whichever source, that capital they are going to use and deploy it in some project, right? When I deploy my money in the project, I am going to get something in return. Only then I will put my money in the project, na? Otherwise, if I'm not going to get any profit, why will I put my money in that type of a project? If I'm taking money from my shareholders, that money I am putting in some project, or I'm doing some kind of an investment, okay, with that help of that money. So that project also has to give me something in return, no, which is over and above the cost. It's like simple, buying a pen for 10 rupees and then selling it at 12 rupees. So that 2 rupees profit is very, very important, right? So whether to accept the project or whether to reject the project will depend upon these two important factors. One is your cost of capital. How much is the company going to bear as a cost for that capital? And how much return on investment are they going to get? What is the rate of return on the investment? See, if it is 12%, yes, of course, 2% is profit, I will accept the project. But say if it is vice versa, my cost is 10, but my rate of return on my investment is only 8%, the project can get rejected. Okay. So minimum benchmark rate which the financial management, advisors and, planners, etc. in the company, they put, which is known as also a hurdle rate, that at least whatever is the cost, that much of rate of return to should be expected, right? And this much should be we get at least in return. Okay. So cost of capital basically talks about overall cost of capital. Means in this particular chapter we are more interested in knowing the overall cost of capital. Why? Because company just does not have one source. They have some in form of equity, they will have some preference, they will also have reserves and surplus with them, they are using money from there. Okay, so that reserves also belong to the equity shareholders, right? They might have taken some loan. So this sources of capital is very important. Because there are different sources of capital and company can deploy more than one of the source, we are more interested in knowing the overall cost. Each cost, of course, but what will be the overall cost of capital? It is kind of written as KO. Okay, KO. So now what is KO? KO is the overall cost of together cost of equity, cost of preference, cost of debt and cost of reserves. Okay, so all these different sources together make it the overall cost of capital. Now, cost of equity. There are different ways of calculating the cost of equity share capital. Okay, first one is your dividend approach, wherein you are using the dividend and the price in order to find how much is the cost, because you are giving dividend on that. So your dividend tomorrow, D1, upon your price today, PO, will give you the cost of equity, KE. Okay, in 200 that will give you the percentage. If you are using the growth approach, in case of the growth approach, we say whatever is the dividend today and dividend tomorrow price today plus whatever growth in the dividend is going to happen in the future on this. Okay, because shareholders expect growth. You keep on giving them same rate of dividend, same thing again and again. Of course not, no. Even they are putting their hard-earned money, they expect something in return. So it will be a growth approach. And last is your earning per share approach, whereas your earning per share and price has been there in the formula, like earning per share, divide that by the price, you will get your cost of equity. Okay, percentage, right? Now PO is everywhere, you will find PO in the denominator in all the formulas. That is your market price today. If nothing is given as the market price, we will take the face value, assume it to be 100. That we will see it later when we will solve the sums. Then we have cost of preference share capital. Okay. Now preference share capital is preference dividend we are paying. So in that we do not have this all these different type of approaches. Only one formula, we have preference dividend upon the price. If DDT is involved by any chance, we will say preference dividend plus DDT, which is generally not the case now. So preference dividend upon the price. Okay. Otherwise, this is the formula for cost of preference shares. Then we have cost of debt. Now what will be the cost for debt? Interest upon the capital. So say if I am paying 10 rupees interest upon a capital of 100, so it will be 10% cost of capital. But here in case of debt, always remember, because you pay interest, your tax benefit is there. Your amount of profit before tax gets reduced. Okay, see this. Say company A has debt and company B has no debt. So their NPBIT, okay, both the companies NPBIT is same, 100. Because of interest, company A 20 rupees was interest, so NPBT became 80. 50% of 80 is 40. Okay, so my tax amount has been reduced. Okay, and I got to use the capital also. Now, 100 rupees is the NPBIT of company B who doesn't have any debt, so there is no interest. So NPBT also will be 100 and 50% directly over here. Okay, so 50 rupees will be the tax. So your tax is more in case of company B. So that means that whenever there is an interest, there is a tax benefit which is in. So in order to take into account the tax benefit, your cost of that debt will reduce. It will not be 10. It will be interest 1 minus tax rate upon price. Okay, to the benefit, to the extent of that tax rate, I get benefit in the only to the extent of the tax rate. Interest 1 minus tax rate upon price will be our formula. Okay, and cost of reserves is like surplus fund. So say company was having 10 lakh rupees. Now they have kept this 10 lakh rupees. They could have invested somewhere, and that 10 lakh rupees they would have got a return on that 10 lakh rupees. So there is an opportunity lost or opportunity cost, and all these reserves and surplus belong to the equity shareholders. So KR is nothing but KE. Okay. Dividend or interest paid is always on the face value. PO is the market price. Okay, so if they're telling you that dividend is paid, rate of dividend is given, or interest rate is given, you will calculate that on the face value, because that cannot be calculated on market price, right? That cannot be calculated on the market price. So face value, and price should also exclude all the other cost. Example, if there is any processing cost, floating cost, etc. So from that price, we are supposed to remove all those costs and take the net price. Okay, so these are some important notes which we are supposed to know it. Okay, now let us okay, now before I move to the formulas, I will just give you one example of what we are talking about, this overall cost of capital. Okay, one simple example. Say a company is starting the business. Rupees 10 lakhs is the amount at which they have started the business. Now, how did they fund this 10 lakh rupees? They are saying equity share capital is 5 lakhs. Then they took a debt on which they are going to pay interest at 10%, 3 lakh rupees. And 2 lakhs is preference share where they will pay 12% preference dividend. Correct? They are giving me the cost also. Cost of equity here is 20. For the debt, obviously 10%, and for the preference share, the cost of dividend is 12%. So when I will calculate the cost on 5 lakhs, if I am taking 20%, it is going to be 1 lakh. On 3 lakhs, 10%, it is going to be 30,000 amount into cost, and 2 lakhs into 12% will be 24. So my total cost, total, is going to be 1 lakh 54. How much is the amount of capital? 10 lakhs. So if I want to find the overall cost of capital, will be the amount of cost divided that by the capital, 200. So 1 lakh 54,000, divide that by 10 lakhs, percentage 15.4%. Or generally what we are going to do in our exams and what they are going to ask in the question will be the allotted weight. Okay, take it as per the weighted average cost of capital. Now, what does the weights mean? They have given me capital, equity, debt and preference, total 10 lakhs. Assign weights to each of the source. 5 divide by 10. 0.5 will be the weight for equity. 3 divide by 10, 0.3. And 2 divide by 10, 0.2 will be the weight for preference. Cost is already given to me. 20%, 10%, 12%. Okay, simple. I have to just multiply that 0.5 into 20. Okay, don't multiply by percent. It means you just say 0.5 into 20. 0.3 into 10. And 0.2 into 12. Okay. 0.2 into 12. 10, 3 and 2.4. Now total it and then put the percentage sign. Weighted average cost of capital is same. Okay. They are asking if the project has a rate of return, okay, has a rate of return 12%, it should be rejected. Okay, rate on the capital employed is 12%, then it should be rejected. Why? Because my cost of capital is 15.4 and rate of return on my capital employed is 12%, then it should be rejected. Okay, so this was just one example to give you all. Okay, now I told you for debt we have this interest factor, which is tax factor, which we consider. Therefore, we say interest 1 minus tax rate upon the price. Okay. Now it can happen that the life of debt is given. Now in case of debt, it is always they are redeemable in a period of 5 years or they're redeemable after a period of 10 years. It can be there, right? In debentures, that is most likely. In case of equity, it is there till lifetime. But in case of debentures, they have a lifespan 10 years, 15 years, etc. And at the time of issue only they decide when they are supposed to redeem, what will be the redemption price. So in that case, the formula will change a little. What it will be, interest 1 minus tax rate is always there, correct? But with that, I will take the redemption value. What will be the price at which they are going to redeem minus the sale value or the issue price at the time of issue, what it was there. Okay, the price, issue price. Divide that by n. N means number of years, life of that debenture. So interest 1 minus tax rate plus this, and then divide that by price we do, right? But now what we will do, we will take an average, redemption value plus sale value upon 2. Sale value is nothing, means sale value for company point of view, when I gave you the debentures, means I sold the debentures to you, na? So for me it becomes the sale value, or you can say issue price. What is the issue price of that debenture? You can write SV or IV or IP, whatever, okay, even in the module, but it is the same meaning. Yeah. Next, in case of preference also, yes, sometimes we have life of the preference share capital, 5 years, 10 years. Same thing, then in that case, we will say dividend upon price is the formula. Okay, if DDT is given, then we will see, otherwise it is dividend upon price. So in case of preference, again dividend upon price is the formula, but here since there is a life, we will take the same thing. Whatever is the redemption value minus the sale value, the issue price. You can say issue price if you want, upon number of years. Okay, so dividend plus this, divide that by the average price. How will I get the average price? RV plus SV upon 2. Okay, cost of equity, we did dividend, earning per share, dividend plus growth, and CAPM model, capital asset pricing model. Okay, this capital asset pricing model we have also done in case of our capital budgeting, and it will come in other chapters also. It is there. If in case you have subscribed to the dream batch, you will be able to see all my lectures, and we have solved this also, CAFM, capital asset pricing method, wherein cost of equity can be found out with the help of RF plus risk-free rate of return plus beta into market risk minus risk-free rate of return. Okay, this is known as the premium. We'll come to it later. Right now, we will just try to complete all the formulas and try to come on the weighted average cost of capital again. So basically, all the total composites, debt, equity, preference, retained earning, mix it, total cost of capital. So you assign the weights to each of them and you can get the total weighted average cost of capital. Weighted average cost of capital. Like how we did in a previous example. Now there is one more example like this. They have given me the values of equity, preference, debentures, loans and reserves, and they have already calculated the cost. So if I am putting all my sources, I'll get a total of 10 lakhs. I can assign the weights now. My weights will be like equity is 2 upon 10. This will be 3 upon 10, 1 upon 10, 1 upon 10 and again 3 upon 10. So based on amount of capital in that total, we will assign the weights. Cost is already again given to us, just multiply. You will get the weighted average cost. When we will total all of this, don't write the percentage. Okay, total it and then write the percentage. Your weighted average cost of capital will be 6.4. 0.2 into 10, 0.3 into 8, 0.1 into 6, 0.1 into 5, 0.3 into 3. So total will be 6. Okay, now let us solve some basic sums. With the help of the basics only we'll be able to solve any big question. Okay, fine. A company wants to issue new 12% debentures of rupees 100 face value. Tax rate is 25%. First, the issue will be at par. Issue is at par means what? Face value is the same as the issue price. Then 20% premium. Then it is 20% discount and last is 10% discount, 5% flotation cost. Calculate the cost of debt. Very nice sum. Everything will get solved over here only. Okay. I know the formula cost of my debt is what? Interest 1 minus tax rate and divide that by price into 100. Now in my each case the price is different. A, B, C and D. The price is going to be different. Tax rate is 25, that will stay fixed. Face value is 100, will stay fixed. 12% debenture interest will stay fixed. What is going to change is the PO in each case. Right? In my first case it is at par, so my PO will be 100. Right? It is at par, so my PO will be 100. 20% premium, my PO will become 120. Discount of 20%, it will become 80. And then again the last one is discount plus flotation. So let us first solve this 3. Interest 1 minus tax rate. Tax rate is 25%. Right? Price in my first case it is at par. Price will be 100. Right? So 12, 1 minus 25% means 0.25. Always convert it into decimal. Always convert into decimal. Right? Into 100. 100 is the price. Okay. 100 is so 100 and 100 basically if you cancel. So 12 into 1 minus 0.25, it will come as 9% here. 1 minus 0.25 into 12. 9. First it is 9%. KD is equal to 9. Second, it is at a premium, right, of 20%. So my price is going to become 120. So on the numerator it is going to be the same. 12 into 1 minus 0.25, divide that will be now 120, 100 plus 20 premium. So it is going to be 7.5%. 1 minus 0.25 into 12, divide that by 120%, 7.5%. Minus 12, divide that by 120, 7.5%. Next is price will be at a discount, at 20% discount. So my PO is going to become 80. Same thing. Multiply that by 100 in order to get the percentage. Okay. So it will be 12 into 1 minus 0.25, divide that by price will be 80. Okay. So 1 minus 0.25 into 12. Divide that by 80. And then percentage. 12.25. 11.25. And the last one is there is a discount. Okay. At the rate of 10%. Right. So that discount is there at the rate of 10%. Also there is a flotation cost of 5%. Okay, so basically from 100 minus 10%. Okay, and then again minus 5%. So you will do 100 minus 10%. You will get 90. Then on that 2 minus 5%. 90 minus 5%. You will get 85.5. Don't take 5% again on 100. Understand? You have a discounted price. The discount is already given at the rate of 10%, and then the flotation cost is involved. Flotation cost of 5%. So first from 100 minus your 10%, you will arrive at the issue price. This is basically your issue price. On issue price, you will have 5% of the flotation cost. So now your actual net price is 85.5. Okay. So when you will calculate this, you will get cost of debt as 10.52. It was a very good sum. Very good sum. Understood? Now the next question. Company has existing debentures rupees 100. Currently they are traded at 125. So this is the market price. This I will take it as PO. This is my face value. Coupon rate is 15%. Coupon rate 15% means what? 15% is the interest rate. 15% on 100, always on the face value, 15 rupees interest. And tax is 20%. Right? So KD is interest 1 minus tax rate. What is the interest? 15. 1 minus tax rate upon the price into 100. What is the price? 125. So 9.6 will be your cost of preference share is of rupees 50, market price is 75. So this is the face value. This is the PO. Coupon rate 15%. Tax rate 20%. Coupon rate means the dividend rate. In this it is the dividend rate. So if I will take 15% on 50, right now? On 50, I am getting 15% of dividend, 7.5. Calculate the cost of the preference shares. Also calculate cost of preference shares if there is a DDT of 10%. So first we will do KP only basic normally. Preference dividend plus DDT upon market price into 100. So 7.5 is the preference dividend. There is no DDT in my first case. Market price is given as 75. So 10% is my cost of preference, my first case. In my second case, there is a DDT of 10%. So 10% it will be obviously on the dividend amount. Huh? So 7.5 is the dividend amount plus DDT is 10% of 7.5. So 0.75 plus 7.5. Divide that by 75%, 11%. Calculate it properly. That is the least thing I expect from you. That to do your calculations properly. A point, percentage, 100 multiply, all this is important. One small silly mistake and you will get a wrong answer for such easy sums. Okay. So done. Now face value rupees 100, company expects to give dividend of rupees 8, company will grow at 7%, calculate KE, I will take the growth formula. Okay, growth formula is nothing but KE is dividend upon price plus the growth. So first separately solve this. Dividend they have given, price also they have given. Separately solve it. Okay, first find the percentage of this. It is 8% plus 7% growth they have given. Growth is how much? 7%. 8% plus 7%. 15% as cost of equity. Calculate either in percentages or in decimal. They have given you all this note also. Important, very important. Okay. Next one. Face value is 100. Market price is 90. DO is 10. P1 is 10.5. Find KE. So now they have given me the previous dividend and they have given me the current dividend. Okay. That means there is a growth of 0.5. 0.5 rupees growth has taken place. So what is the growth percentage? 5% now. Okay. Now I have to find KE. So my growth is 0.5. 5% is my growth rate. How I got 10.5? 10. 0.5 increase in the dividend is as compared to dividend for year 0, dividend for year 1 now. Okay, so this 0.5, if I have to find the growth percentage, 0.5 upon the base dividend. So the increase in the dividend upon the DO into 105%. Now KE I can find. KE is D1 upon PO, right, into 100 plus the growth rate. Growth rate I have already calculated 5%. D1 is how much? 10.5. PO is 90. Right? Into 100, I am getting 11.67 plus 5. So total will be 0.67%. 10.5 divided by 11.6 plus 5% of our growth. So this was a hidden thing. Which formula we had to use? The growth formula for finding the cost of D. Okay. Question number 6. DO is 10, growth rate is 5%, market price is 105, find K. Okay. So now D1. How will I get my D1? They have given me DO 10 and they have given me the growth rate. So simple, 10 plus 5%, 10.5 will be equal to my D1. D1 upon the market price plus the growth. So this is going to be into 100. 10.5 divided by market price is 105 into 100. This is coming as 10% plus growth rate 5%. So total is 15%. Now one more question. Question number 7. Company wants to issue debentures of rupees 100 each face value, carrying interest of 10% and its for life is 10 years. 30% is the tax rate. Calculate KD of the debentures if issue is 10% discount and redemption will be at par. So redemption value will be 100 rupees and discount. Issue is at a discount. That means issue value, or you can say issue price or sales value will be 10% discount means 90. Right? First A1 I am doing. So interest 1 minus tax rate plus RV minus issue price upon N number of years. Divide that by the average price RV plus IP upon 2. Right? Interest is given to me 10. 1 minus tax rate is also given. Plus they have also given to me redemption value. They have given me the issue price which is 90. What is the life? 10. So solve this separately. 10 upon 10, no? This will be 10 upon 10 will be 1. So first 10 into 0.7 will be 7. 10 into 0.7 only, 1 minus 0.3. 10. So this is going to be 7. Then 100 minus 90 is 90. 100 minus 90 is 10 upon 10 will be 1. So 7 plus 1. And the denominator is the average price. 100 plus 90. Divide that by 2. 95 rupees the price. Just put the multiplication sign into 100 to find the rate into form of interest rate. So it is going to be 8 divided by 95%. 8.42. Okay, so even this type of sums will be easy now for us to solve. The second one is issue is at 10% premium. Okay, so issue price is going to be 110 and redemption value is at par again 100 rupees. Okay, so same formula, interest 1 minus tax rate. Okay, this I will solve it separately, plus it is RV redemption value minus issue price upon N. And this average we already know average will be 100. That is your redemption value plus your issue price upon 2. 100 plus 110 divided by 2 is 105. Okay, so this denominator is sorted. We know this is calculated, we get 7. 0.7 into 10 is 7. Now here if you see 100 minus 110, It will be minus 10. It will be minus 10 upon 10. Okay, so when the brackets will open, this plus sign will become minus over here. Okay, this plus will become minus. Plus sign will become minus 1 upon 100 and so 7 minus 1, 6 upon 105 into 100. So 5.71 will be cost of. Okay, just be careful. Whenever your issue price will be more than your redemption value, your plus sign will get changed into minus sign. I am getting certain students who are messaging me, sending me pictures on this. So this is the basic maths which you are supposed to know. Okay, plus and minus is minus, right? So we have solved all the basic questions. Now let us move to another question, another type, wherein we will find the book value weights and the market value weight. Based on that, we will find the weighted average cost of capital. So now we all know how to assign the weights. Only small change in this type of a sum, that if they tell you do it as per the book value weights, we will assign the weights as per the value which is given in the book. And if they tell you assign the weights as per the market value, then we will calculate the market value and then assign. So determine the weighted average cost of capital using book value weights and using market value weights. The book value structure they have given only to me. Debentures, face value is 100 per debenture, 8 lakh rupees. Preference share 100 per share, 2 lakh rupees, and equity shares 10 per share, 10 lakh rupees. So basically these are the face values. So total comes to 20 lakhs. Then recently the market prices are debenture is 110 in the market, preference is 120 and equity share is 22 rupees. The cost of each component they have already calculated, cost of debt, cost of equity and cost of preference. We are supposed to find the book value weight and the market value weights, and based on that we are supposed to find the weighted average cost of capital. Okay, so see this. Now book value weight. I am doing first the book values. Sources, amounts, weights. This is how you are going to write even in the paper. This neatly like this you are going to make the columns and write it everything properly. They have given me the sources now. They have only told me debentures. Then they have preference shares, debentures, preference shares and equity. All this is given to me. I am just assigning them the weights. 8 divided by 20. 8 lakhs divided by 20. This is 2 lakhs divided by 20. And this is 10 lakhs divided by 20. So I got my book value weights. Cost is already given to me. So I did not write only the percentage in this column. I wrote percentage directly on top. Cost is given in form of percentage. But I am just going to write the figures. Here it is given to me. 7.4, 17 is KE and KP is 14.87. Okay, so KP 14.87, KD 7.4 and equity is 17. So I am going to multiply my weights with the cost in order to get the weighted average cost of capital. So 7.04 into 0.4, 2.816, right, this is correct. Then 0.1 into 14.87, 1.48. And then 17 into 0.5, 8.5. When you will add them all, 8.5 plus 1.487 plus 2.816, you will get 12.80 as the weighted average cost of capital based on the book value weight. Okay. Now same sum with the help of the market value. The sources are same, 3. Debentures, preference shares and equity. But the amount will now change. What will happen is debentures is 110 rupees. How many debentures do we have? We have face value 100. 8 lakhs is the debentures amount. So 8 lakhs divided by 100, 8,000 debentures. So 8,000 into 110. Preference shares, we have 2,000 into 120. And equity shares, we have 1 lakh equity shares into 22. So this will become my amount. Okay, 8 lakh 80, 8,000 into 110. Then you have 2,000 into 120. And you have 1 lakh into 22. Okay, 1 lakh into 22. So total is coming up as 33 lakh 20,000. Now I will assign weights. How will I assign weights? I will say 8 lakh 80,000 divide by 33 lakh 20,000. First, 0.2651. I am taking up till the 4 decimals. Round up the last one. Okay. Then 2 lakh 40 divided by 33 lakh 20,000. That means the amount of that component, divide that by total. 0.0723. Then 22 lakhs, divide that by 33 lakh 20,000. 0.662. Cost is already given. Just multiply the weights with the cost. Okay, so 0.2651 into 7.04, 1.87. Then 0.073 into 14.87, 1.075. You can take it up to 4 decimals. Even the first one, 0.2651 into 7.8. You can take it as 866. Okay. Up till the 4 decimals, 3 decimals, or you can even take it up to 2 decimals. Round it up with the last one. Okay. Whatever it is, okay with you all. So weighted average cost of capital is 14.21%. Okay. So one very important sum, and these type of questions are asked in the exam. Okay. One more weighted average cost of capital we will do. Capital structure 10% debentures. Now 10% debentures mean this is the rate of interest. This is the rate of preference dividend, and 5,000 equity shares of rupees 100. So 5 lakhs here, preference share 2 lakhs, debentures 3 lakhs, total is 10 lakhs. Equity share of the companies are quoted at 102. Company is expected to declare a dividend of rupees 9 per share. Tax rate is 50%. You are supposed to find the weighted average cost of capital. Now they have not given me the KD, KP and KE. We have to calculate all of that. Okay. So see here. First I started with cost of debt in the notes. Interest 1 minus tax rate upon price. Okay. Now interest is given. Tax rate is also given to me 50%. So interest 1 minus tax rate. Now they have not given me anything about the price or anything about the face value. You will always assume it to be 100. Okay, assume it to be 100. 100. Okay. So divide that by 100. Market price will become like 100. So 5%. Cost of preference share is preference dividend upon the price. Have they given me the price? In case of no, so again I am assuming it to be 100 face value. Whatever is the face value, and we are assuming that to be the market price also. So preference dividend rate is given 10%. Na? So 10% on 100 will be 10 rupees. So preference dividend 10. There is no DDT upon 100. 10%. And KE, cost of equity. They have given me the amount of dividend. Company is expected to declare the dividend. That means it is D1 is 9. Okay, market price they have given me is 102. And find this. D1 upon price. 9 upon 102. 8.82%. Okay, so I have cost of equity, I have cost of preference share, and I have cost of debt. All the sources are there. Weights have been assigned 3 upon 10, 2 upon 10 and 5 upon. Weights, cost we calculated, cost of debt we got 5%, preference 10%, and equity is 8.82. So just multiply the weights with the cost. 5 into 0.3, 1.5, 10 into 0.2, 2, and 8.82 into 0.5, 4.41. Total 7.91 is the weighted average cost of capital. Okay. So basically, I have kind of calculated all the important, I've taken up all the important sums from my books. Been, whatever we have solved over the period of time and certain things from the module. Important ones I have covered it, and now we are going to go to the past exam. This was basically an entire comprehensive study, and now this is going to help us solve this past exam question also. Let's read it. So, Magma Limited is a manufacturing industry which has a mix of equity and debt to finance its business. The company is growing at a considerable rate, promoting the management to go for expansion. The company is considering various alternatives to raise funds for the same. They are saying 12% debenture first issue, then they have 13% debenture second issue. They also have 10% preference shares, equity shares rupees 10 per share is the face value, and they have retained earnings. So all these are the sources of their capital. Equity shares are sold in the market at 25 rupees per share. Company is contemplating to declare a dividend of 3 per share at the end of the current financial year. The company has a practice of paying all the earnings in the form of dividend. Rupees 100 per debenture first issue, redeemable at par, has 2% flotation cost and 8 years of maturity. Market price is 120. The second issue debentures rupees 100 each is redeemable after 5 years, and they are currently selling at a 90 per debenture. Rupees 100 per preference shares are redeemable at par, has 3% flotation cost and 10 years of maturity. Market price of this preference share is 108. The tax rate is 25%. The shareholders' tax liability may be assumed as 25, whereas the capital gain tax is 20%. So the income tax rate for profit is 30, shareholders tax liability, that means the dividend tax which they are paying is 25, and capital gain tax is 20. The CFO of the company is keen in understanding the cost of capital. Accordingly, you are appointed to complete the following task. Find out the weighted average cost of capital using book value weights and market value. Further, the company also intends to know the market price of the equity shares at the end of the current year using M&M approach along with the citing assumptions of the theory. Assuming the company has a sales of 20 lakhs, variable cost of 12 lakhs, fixed cost of 5 lakhs, excluding of interest. Calculate operating leverage, financial leverage and combined. So I will keep my question here. We have to find the weighted average cost of capital. This is my first question. Book value weights and then the market value weights. So I am on the first question. Okay, to find the weighted average cost of capital, I will first need the cost of debt, preference share and equity. So let us find that. I have two types of debt, first and second. So cost of debt, I have just written down the formula: interest 1 minus tax rate plus RV minus SV upon N upon RV plus SV upon 2. Why I have done that? Because this particular debenture has life and they have separate debenture value, or redemption value and issue price. Okay. SV is nothing but issue price. Same. Okay. Now cost of debentures first issue. How much is the rate of interest? 12%. Okay, and rupees 100 per debenture. Okay, it is redeemable at par. So the face value is also 100. So on 12%, 100 rupees, 12% will be 12 rupees. 1 minus tax rate is already given to plus. For the first debenture, they are saying it is redeemable at par. That means redemption value is 100. Okay, and has a flotation 2% flotation cost, and it is 8 years of maturity. Okay, now 2% flotation cost means what? My issue price at the time of the issue, this flotation cost was involved, right? So my issue price has changed. My issue price or my sale value will be 100 minus 2%. 100 minus 2, 98. So I have written that only. This is the redemption value. This is the sale value. Then number of years is 8. Then redemption value plus sale value upon 2, I am finding the average. So 1 minus 0.3 is 0.7. 0.7 into 12, just do it. 8.4. So my first bracket is already, this is solved. Then 100 minus 98 is 2. Right? 2 divide that by 8. 0.25. And what will be my average price? 100 plus 98 divided by 2, 99. It is going to be 0.087. If I have not multiplied this by 100. That means I am not writing it in percentage form. I am just keeping it in points form. 0.087. Same thing I will have to do for the second issue. Now for the second issue, again the face value is 100, is redeemable after 5 years, and are currently selling at 90 per debenture. Okay. So 13 rupees is the rate of interest. 13 rupees is the interest. Why? Because 13% is the rate of interest. Face value again of this debenture is 100. So 13% on 100 is 13. 13 1 minus tax rate plus redemption value is again the same thing. It is to be redeemed at par. Second issue is redeemable after 5 years. Okay. So the redemption is going to be at par. Issue price is also 100 only, no? Sale price. Sale price is also 100. Issued also at 100. Redemption is also at 100. Life is 5 years. Divide that by the average. 100 plus 100 upon 2. So this is going to become 0. No, 100 minus 100 is 0. Divide by 5, it will be 0. So 0.7 into 13 will be 9.1 plus 0 upon 100 will be the average price. It will be 0.091 cost of the debenture second. Then we have cost of preference share. Okay, so debenture is done. Now preference share is again 100 rupees value, face value. Okay, they have 10% of dividend on that. Okay, now they are saying 100 redeemable, it is redeemable at par. Redemption value is par and has 3% flotation cost. That means my sale value or issue price was 100 minus 3%, and 10 years is the maturity. Okay, so preference dividend, it is going to be how much? 10 rupees, because it is 10% on face value, right? So face value is 100 plus RV is 100. SV will be 97. 100 minus 3 upon 10 is the life of the preference shares. Divide that by the average. 100 plus 97 upon 2. Average is 98.5. So preference dividend 10 plus 100 minus 97 is going to be how much? 100 minus 97, divide that by 10. 0.3. Divide that by 98.5. I have kept all in decimals. So cost of preference share is 0.1046. If I would have done multiplied by 100, I would have got it in form of percentage, right? 10.46. I have kept it in form of decimals only. So cost of preference share calculated. This market price which they have given, 108, selling at 90, 120, that I will take it at the time of doing market value weights to find the amounts. Okay. Now cost of equity. They are going to declare a dividend of rupees 3 per share. Okay. And the market price is 25 right now. So D1 upon market price I can do 3 upon 25. Both is given to me. 0.12 will be my cost of equity. Last one is my retained earnings. Now this is important. Okay, retained earnings is 1,50,000 is there. I'll have to find the cost of retained. Okay, cost of retained earnings is same like cost of equity. Okay, it is like same like cost of equity, but in this case now I will take dividend 1 minus the tax one, the marginal tax rate. Marginal tax rate is what? 25% for the shareholders, and capital gain tax is also 20. Right? In case of equity now there is no tax which is payable by the company. No, the shareholders themselves they pay. But for calculation of KR, specifically when they have given me these type of tax rates, shareholders tax liability, since reserves also belong to them and company has a habit of giving all the reserves in form of dividend. So the cost of reserves will be what? That dividend and this tax rate is involved, 1 minus tax rate. And in that case of market price also, I'll have to multiply that by 1 minus the capital gain tax rate. Why? Because today when I will sell my that shares in the market, that capital gain tax will be there, 20% which is there, correct? So 3 rupees is the dividend, 1 minus tax rate is 0.25, the marginal tax rate for the shareholders. Company tax rate is 0.30, that is different. And 25 into 1 minus 0.20, so 2.25 upon 20, this is going to be my cost of reserves, taking into consideration the amount of tax which is involved for the shareholder. Okay, so cost of equity, cost of retained earnings, everything we have got, all the cost. I have just taken and written down the book value and written down the cost. Made this table: equity shares 10%, preference share capital 12%, debentures 13%, debentures, and retained earnings. And I have just taken all these amounts. Equity shares 6 lakhs, preference share is 2 lakh 50, 12% debenture is 3 lakhs, 13% debenture is 2 lakhs, retained earning is 1 lakh 50. So total is 15 lakhs. So 6 divided by 15, weight is 0.4. 2.5 divided by 15, 0.167. Then 3 divided by 15, 0.2. Okay, 2 divided by 15, 0.133. And 15 divided by 1.5 divided by 15, 0.1. Cost is what we have calculated. Okay, all those costs I have just taken and put over here. Cost of retained earnings, then debentures 13%, 12% debentures, preference, and equity. Simple, multiply them, you will get the weighted average cost of capital total into 100, you will get it in the form of percent, 10.6. You can even do it in percentage while you are solving it and finding the cost, okay? There is nothing right or wrong in that. Now coming to the market value. Cost will remain the same, but the weights will change. Why? Because now the amounts are going to change. Why? Now see, equity shares, 10 rupees is the face value. That means there are 60,000 shares running at a market price of 25. Then we have 12% preference shares, 10% cumulative preference shares, their face value is also 100. So we have 2,500 preference shares. Their market price is currently running at 108 rupees. 2,500 into 108. Then we have 3,000 debentures here, the first debentures, then these are 2,000 second debentures. The first debentures market price is 120. 3,000 into 120. And the second debentures market price is running at rupees 90. So 2,000 into 90. And retained earnings will remain same. Okay. So 60,000 into 25 will be 15 lakhs. Then 2,500 into 108. It will be 2,70,000. Then 3,000 into 120. 3,60,000. Then you have 2,000 into 90. 1,80,000. And retained earnings 1,50,000. Now weights you will assign according to the total. Now what is the total? 15 lakhs plus 2,70,000 plus 3,60,000 plus 1,80,000 plus 1,50,000. 24,60,000 is our total. Now simply do 15 lakhs divide by 24,60,000. What even I have done. Take it up to 2 decimals and round it up. 0.6. 2,70,000 divided by 24,60,000. 11. 1. 3,60,000 divided by 24 lakh. 0.14146, or you can say 0.15. Then you have 1,80,000 divided by 24 lakh. 0.073, and 1,50,000 divided by 24,60. 0.06. When you will add all of them, you will get 1. Wait. Cost is already we have calculated. We will multiply the weights and the cost. Calculate the weighted average cost of capital. You can take it maximum up to 4 decimals. Okay, maximum. Since you know it's a bigger number, take it up to 4 decimals and you will get 0.1109. Just multiply that by 100. Your weighted average cost will be 11.0. Okay, so this was just the first part which we have solved. Okay. Now the second. They are saying the company intends to know the market price of the equity shares at the end of the year. Okay, so market price of the equity shares at the end of the current year. What is the formula we are using? Cost of equity is dividend upon price. Okay, M&M theory says that what is the P1? What is the price? Price is nothing but the base price into 1 plus cost of equity minus the dividend. So base price is 25. 1 plus KE we have already calculated 0.2 and dividend they have given it to me. So it is 25. Okay. It is as per the M&M approach. Price is nothing but PO into plus KE minus D1. We are doing we can do this also. No? Have been doing this. Cost of equity is dividend upon price. So price will be dividend 1 upon KE. So when you do this PO, take it on the top 1 plus KE minus D1, your P1. Same thing. Even if you are doing this, you are getting 25 rupees. When you are doing M&M approach also, you are getting the 25. Now assumptions of M&M hypnothesis theory that you can just write it on later. That we can do it when we are doing that M&M approach capital structure. Okay. Now assuming, this is important, assuming company has sales of 20 lakhs, variable cost, fixed cost, we are supposed to find the leverages excluding of interest. Okay. So now I have just written for calculation of leverages, sales is how much? 20 lakhs. Variable cost is 12 lakhs. So contribution 8 lakhs. Fixed cost they have told me how much? 5 lakhs I have written. So NPBIT is 3 lakhs. How much is the interest? Interest is how much? 36,000 and 26,000. How did I get this 36,000 and 26,000? From here. 12% on 3 lakhs. Right? 36,000 is the interest here. And on 2 lakhs, 13%. 26. So total interest is going to be 62,000. Interest. So NPBT 2,38,000, tax rate they have given me 30%. So net profit after tax is 1,62,000. Now degree of operating leverage. Degree of operating leverage will be contribution upon NPBIT. Why? Because we are talking something about the fixed cost absorption, right? So it is going to be contribution upon NPBIT. Degree of operating leverage 8 lakhs upon 3 lakhs. 2.67 times. Degree of financial leverage. Degree of financial leverage. We are talking about interest absorption. NPBIT upon NPBT 3 lakhs upon 6. 3 lakhs upon 2,38,000. 1.26 times, and multiply them both, you will get degree of combined leverage 3.3. Okay, so we have done a big question for the exams, right? Now there is one small question again. Following statement, financial statement extract of XYZ Limited is there. We have operating profit, interest on debentures less interest on debentures, you get 72. Less income tax, you will get net profit. Equity share capital 10 rupees each, 100. Reserves and surplus 100 lakh, 15% non-convertible debentures rupees 100 each, 20 lakhs. So the total capital is 520. The market price of the equity share is rupees 12 and the per debenture it is 90.75. Calculate earning per share, percentage cost of capital of the company for debenture funds and the equity. Okay, easy, 5 marks. Earning per share is what? Whatever the profit is available for the equity shareholders, divide that by the number of shares. How much is the profit available for equity shareholders here after tax and everything? 50 lakh 40,000. It is in lakhs, no? So 50 lakh 40,000. Number of equity shares 200 lakh shares. Divide that by 10. So how many equity shares are there? 20 lakh. So earning per share is 2.52. All this is important, na? Amount in lakhs and all that. So try to be careful when you solve. Then they're asking me what will be my cost of equity. So I got my earning per share. I have got the price also. So cost of equity, earning per share upon price. Earning per share, we just calculated, price is given 12 into 21%. And cost of debentures, as per the book value and as per the market value, both I have done. Interest 1 minus tax rate upon price. Interest is 15 rupees. How? 15% on 100. 15 rupees, 1 minus tax rate is 0.07, 1 minus 0.03, 0.30, divide that by 100. So it is 10.5%, and as per the market value, I have taken 90.75 as the price. Okay, so 15 to 1 minus 0.30, divide that by 90.75. Percentage will be 11.20%. Okay. So both have been done, both the questions. This was it from your past exam questions for these two chapters, leverages, and for your cost of capital chapter. Okay. So with this, I have completed your two important chapters from your financial management, which is like you have completed today good 15 marks of your FM out of 40. Okay. So now I'll see you all again in my next marathon. I hope you all have understood this marathon. You have understood these two chapters, and it will be helpful for you all. You all can revise with the help of my notes. And if you all have any questions, any doubts, you all can put it on my chat. Okay. Until then, I will see you all in my next class. Bye bye.